8.6% lower for the Nifty. Now we have hit and also breached the 25,800 mark, viewers. That's also slipping near the day's low point after a lot of choppiness that has really dented sentiments through the course of the day. Most of the sectors have now come under pressure. The Nifty Bank is now also lower, but it's the IT pack that is really taking a beating. 5% lower for the IT index as a whole. Real estate is down by over 1%. Oil and gas down by 1%. Mid and small caps also losing up to 1% in trade, barring metals and financial services. The only two sectors that are still holding into some green, but rest of the sectors have all slipped. On the Nifty, you have Bajaj Finance continuing to soar higher, bucking the trend, 3% up in trade. Shriram Finance also up by 2% in trade right now. Eicher Motors 2% higher, about 2 to 2.5%, 3% kind of moves on these top gainers. You have Trent, ICICI Bank and BEL from the defense space that's also buzzing in action. But what's not doing well? No surprises for guessing, it's the IT pack. Infosys 5.5 to 6% lower. Tech Mahindra, TCS, among the top 5 losers on trade, you will find all of them within the IT pack. All the big 5 IT firms are the top losers as far as the Nifty is concerned. Let me quickly welcome our guest on board, Devarsh Vakil, Head of Prime Research, HDFC Securities, is joining in on this program. Hi Devarsh, warm welcome to you. Your sense of the IT stocks beating that we have seen today, is this something to worry about? Of course, there are fresh AI fears. This comes on the back of underperformance over the last entire year for the IT sector and not too bad earnings of Q3 as well. No negative surprises were seen across the IT numbers that we saw, but still it's these fresh AI fears that have really taken away all the sheen from this space. How would you look at it?
Hi, thanks for having me. It's a pleasure to be on your show. So, you see, major IT companies have announced mixed results, and as you mentioned, the revenue growth was there, but obviously there were profit was under pressure. One-time labor charges, if we just exclude that also, the margin was under pressure. Now, I think this is a transition period for Indian IT services company. They are passing through a AI-led disruption and they will have to restructure their business models. So it is time to remain cautious on that. We have been cautious on the IT and we have asked investors to remain under weight on this. The impact of IT, not only on the IT services, but all across the board is now being felt because as more and more new versions of the new softwares are being deployed. In fact, not only in Indian IT companies, the US IT companies, services companies, US financial service companies, all are
right
under the business models of companies.
So what would you say investors do at this point in time? Should one completely exit IT? If somebody is big on IT, should one just stay on, let this things clear out, or should one reduce exposure or maybe take the benefit of this dip? What would you advise of all these 3 options?
So I would say we should wait. We should wait for further dip before jumping in. I do not see very large downside from IT companies because these companies have started restructuring their business model from now outcome-based businesses and contracts. And mind you, these companies have a lot of cash on the balance sheet. So if there were to be a meaningful downside, I expect these companies, especially after the recent changes in the budget, to announce buyback and support their prices at the lower level. So I'm not very bearish from this prices, though we would wait for further clarity before adding back to our IT exposure.
All right. Well, we'll also shift focus to what's happening as far as the India-US trade deal is concerned. Remember, there was some enthusiasm on the markets also on the back of that, with India securing lower tariffs under the India-US trade deal. The country is definitely set to gain a significant find out when it comes to the US-India trade deal, the kind of concerns that we initially had when it came to the Bangladesh exports, also getting a better deal of 0 tariffs to some of the products. There are textile stocks also reacted, but there's a clarification that Piyush Goyal, our Commerce Minister, has given that it's not pan products, but it is limited to a certain products, and that Bangladesh stands to benefit only when they import certain products, or the cotton that is originally made in the US is when they will have to pay zero hike. How would you really read this with respect to the textile stocks back home?
So the trade deal, the US lowering the reciprocal tariffs has unlocked the opportunity. See, US imports about 118 billion worth of textile every year, and India, along with the Bangladesh and others, are a significant player. So this reduction in duty is most welcome for the sector, which was really struggling and reeling under the duties. Now, the recent deal with the Bangladesh, as the minister pointed out, it is only when they import the US material, and that clause is also open for Indian players as well. The worry is that the Bangladesh has very low wage, and especially in the apparel sector, and that's where they export about 80% of their production. So yes, it is a worry, but I think Indian players across the years have learned to compete with Bangladesh players. So I don't think that will be a big challenge. The deals which export orders which our players will get through because of this deal will help them revive the business.
Right. Let's also shift focus to the auto space and try and find out how is the industry really looking at the trade deals that are taking place. We are also... Right. Devarsh, coming to you, you heard the management out there from M&M talking about how are they looking at opportunities on the back of the trade deals, as well as the price hikes that they have taken. What's your view on the auto sector and on M&M?
Right. So, export side, I don't think there is much impact, but actually the Indian OEM makers are having a fantastic run on the domestic front. The PV numbers, if you see for the January, they were upward of 12%. I saw TVs also, two-wheeler also growing about 25-30%, and the tractors, the agri side, they have fantastic 45% kind of YY growth in the month of January. So numbers are very strong, and I think this momentum is expected to continue for the next month also, because there are a lot of new launches and the year-end demand will also start kicking in. There is a slight price hike by this OEM, and that may dent the demand a little bit, but I don't think that will be impacting or derailing the overall numbers. So we think that the auto stocks continue to remain strong. There are government schemes where they have actually allocated on the PLI side 5,940 crore for the auto component exports also. So not only the OEM players, we feel that there is an opportunity at the auto components, and there we may see a lot of advanced technology coming in and investments from abroad also coming into India. So I think auto and auto ancillary should continue to remain as a part of your portfolio.
Okay. Shifting focus to the aviation space now. India's top airline had taken a massive beating in December, slowly and gradually again taking off in Jan. How is it placed right now, and what is your expectation going forward amidst all these regulatory changes?
Right. So right now we don't have a coverage on the aviation, especially stocks, but this is a sector where at lower levels every investor must look at it. Despite the recent turmoil, I think as our disposable income grows and as the infrastructure on airports and new flights, new aircrafts will come in, this will become even more affordable for Indians. And I think the overall growth is going to be fantastic. So at lower level, we will again relook at these stocks. Once these regulatory concerns and all these issues are over, I think it will be again a good time to relook at this sector.
Right. Devarsh, apart from the sectors that we've discussed today, what is it that's coming onto your radar afresh? We've had some of the massive news flows now behind us. The budget is behind, the US-India trade deal is behind, EU trade deal is also behind us as well. So, and the earnings are largely over for Q3. What is it that the markets should look out for as key triggers, and what is it that you're watching out for in the markets as opportunities?
Right. So, on aggregate side, on aggregate Nifty, I think we had a tepid year, 2026. I think we are looking at a 2027, FY27 as a year where earnings will make a comeback.
Okay.
On the Nifty aggregate side, we are looking at around 1280 to 1300 kind of EPS number for Nifty. That means about 15 to 17% growth on the top of 26. And we are now more or less trading around 19 times forward earnings. So valuation have become attractive, and this is a time where many of the mid cap and small caps have already corrected a lot, and we need to find good opportunities in there. Over the next 3 months, if we accumulate good stocks with decent management and a good earnings growth, I think there is money to be made in the market. The sectors where we are looking or fishing for opportunities, obviously the banking and finance, the BFSI space, especially on the NBFC side, I think there are good opportunities there. We continue to like the auto and the telecom space, which we were anyway overweight. Defense stocks have corrected, and I think there is opportunity there. We should relook at defense stocks. And government has done a lot of capex. The capex has been driven by government, but I think this year we may see a rebound and relook at the private capex also. So engineering, infrastructure, consumption, all these themes are likely to make a good comeback. So investors actually spoiled for choice this year.
Okay, investors will be spoiled for choice. We've been waiting for such kind of an opportunity to really come in, Devarsh, and you're definitely showing us the light there. You did also point out that you believe the mid and the small caps could have a brighter space to look at now. They have underperformed the large caps in the last year. Finally, if you're seeing light at the end of the tunnel as far as the mid and small caps are concerned, many investors invest via mutual funds when it comes to their positions in mid caps and small caps, and that's also a preferred way for retail investors because mid and small caps have higher risk than the large caps, so it's better to go via the fund manager's route. How would you really look at the opportunities within the mid and small caps? Should one double down their SIPs in mid and small caps?
I think so. See, discipline. Over the years, we have seen that the investors who actually made good money stick to basic rules. Basic rules are that you keep reviewing your asset allocation. When there is one asset class which becomes a larger part of portfolio, you trim exposure. Basic rules are that you keep reviewing your asset allocation. When there is one asset class which becomes a larger part of portfolio, you trim exposure there, and that would be, I think, exposure towards the bullion now. We have been recommending 10 to 15% allocation there. Maybe you can bring it back to 10 to 15% and allocate that money towards the mid cap and small cap mutual funds. Obviously, we don't do any research on there, but there are plenty of information available out there to look at good mutual fund with a good track record, and you can allocate certain capital towards it. I think if you do SIP and if you stick to asset allocation, next year should be good for investors.
Okay, let's quickly wrap up the markets and come back to you, Devarsh, with all our viewers' questions. We have sharp viewers below 25,800 mark. There's a sharp drop of about 156 odd points on the Nifty. So we have seen a down day, a clearly choppy and lower on the Nifty. Infosys down by 5.8%, TCS down by 5.5%. We've also seen TCS market cap drop down below the 10 lakh crore rupees mark as well. Wipro, HCL Tech, all five of the top five losers are from the IT pack, along with M&M. That's dropped by 2.2%. This is despite strong earnings coming in line with the estimates that we've actually seen. And brokerage houses also raising their target prices. M&M has still slipped in trade right after. But coming to your questions now, Devarsh, we have the first question from our viewer Suman from Delhi. She wants to know about IT stocks again. She says IT stocks are down, so should I buy this dip or will the fall continue for some more time?
The majority of the large part of the fall may be already in the prices, but I see there is still, it is going to be lackluster unless we see some new triggers. I don't see any reason to increase allocation towards IT sector now. Maybe around 5 to 10% lower. There should be some relook at the stocks, but I would wait for clarity to emerge before committing new capital to IT stocks as of now.
All right. Thanks a lot, Devarsh, for being with us and for answering those questions of our viewers as well as giving us an insight on the markets. Viewers, it's a wrap on the Business Today show. In case you too have any questions about your own investments in mutual funds, your SIPs, stocks related, or even gold related queries, then please do send them to us on the number that's flashing on your screens. We'll be happy to address all these questions.